So far, as we've been discussing trends and market structure, we've done so in a way of using textbook utopian examples of what trends should appear to be, or conceptually what they are on a price chart. Price makes a high or a low, then pulls back, and then breaks through the previous high or low and continues the trend on and on until it doesn't. The market isn't exactly picture perfect, and pullbacks frequently make things more difficult to understand. Pullbacks frequently have more ebbs and flows to them than just a simple singular pullback. The significance of structural ranges must therefore be understood a little bit further. So, first off, what is a structural range? A structural range depicts where price is currently trading and is simply the distance between the high and a low in a bull trend, or the distance between a low and a high in a bear trend. We use structural ranges to help us stay focused on the current impulsive legs of market structure. That way we don't lose sight of the correct invalidation points of the structure the market is currently working within. If the high of the bullish structural range is broken, the market is beginning to create a new bullish structural range and the trend is continuing. If the low of a bullish structural range is broken, the market is beginning to reverse and is likely to create a bearish structural range. If the low of a bearish structural range is broken, the market is beginning to create a new bearish structural range and the trend is continuing. If the high of a structural range is broken, the market is beginning to reverse and is likely to create a bullish structural range. And as I said, the structural ranges are depicted as the low and the high of a bullish structural range, the low of the high of a bullish structural range. And more specifically, if we're just looking at this, when we're trading within this low and this high, the invalidation low would be our key point that if price breaks to the downside, breaks and closes below and hard closes below, we would see some sort of reversal and we would no longer be seeing bullish price action. And if we break the continuation high, this would be a continuation of the trend, which we would expect a new higher high to form. And on a bearish structural range, we would have, if we were trading between this swing high and this swing low, our invalidation point, if we broke to the upside and broke and closed above to the upside and hard close, we would have an indication that the bearish trend is reversing, potentially turning into a bullish trend, and that would invalidate our bearish structure. Whereas if we continue to move to the downside, breaking the continuation low, this would signify that price is more than likely forming a new lower low and the bearish trend is continuing. So we can take it a step further and discuss complex pullbacks. As we said up until this point, the pullback phases that we've been referring to have been pretty simple in nature, a couple candles counter to the actual trend. But the market, like I stated, is not quite that utopian, and the pullback phases can catch us off guard if we're not paying attention. A complex pullback is a larger pullback that makes internal structure in relation to the structural range. This is, in some ways, you could call it structure within structure. Complex pullbacks can be difficult to navigate if the structural range isn't kept in mind. Any highs and lows inside the substructural ranges are part of complex pullbacks and don't contribute to swing structure until the high or the lows of the structural range are broken. Now let's just take a look at a bullish example where we're seeing a series of higher highs and higher lows. And one thing that you can probably pick out right immediately is that the pullback phases that we're seeing in the market are significantly different than what we've seen up until this point. They're a lot more defined. They have their own set of internal market structure inside. So what we can see is when we look at this pullback phase that's happening, we create a low, a lower high, a lower low. This one actually has a higher high and then a lower high. Very confusing structure to be trying to follow suit with in the market. But this is where the concept of structural ranges becomes incredibly important to keep us in tune of what's actually happening. We can see that the market is creating a series of higher highs, higher low, higher high. So we're trading within this high and this low. So any market structure that's happening inside of the range is considered internal structure and would be part of a complex pullback. And as we can see, price continues on. We form our higher low and continue moving to the upside, breaking above the previous high, forming a new higher high. And the complex pullback gets a little bit more complex just to really drive the point home. And as we can see in this complex pullback, we create a low, we create a lower high, a lower low, a higher high, a lower low, create a high, we create a higher low, a higher high, a lower low, a high, a low, a higher low, a higher high, create a lower low. But if we just look relative to what is our structural range that we're trading within, we're trading between this high and this low. This would be our continuation high, and this would be our invalidation point low. So if we break and close below this low, we have invalidated the bullish structure and could potentially be switching bearish. And if we break above this high, we are continuing that bullish trend. Everything that's happening inside, all the structure that's being created inside of this bullish range is part of that complex pullback. And as we can see, the higher low forms and we continue moving to the upside, breaking above the previous high, forming a new higher high and continuing the bullish trend further. Now, if we flip that and just look at a bearish example, just to be for completeness sake, what we can see is we are creating a series of lower lows and lower highs. We start to initiate that pullback phase. We create a high, we create a higher low, which would be in essence a candle swing formation, and we start to trade lower, creating the new impulsive phase and break the previous low. Again, if we're not careful, and we're not keeping in mind the structural range that we're trading within, this high and this low, we could start to believe that the price is starting to change bullish. But what we need to remember is that this is our invalidation high and this is our continuation low for our bearish trend. So long as price maintains within the structural range and does not break the invalidation point high, we are still in a bearish trending market, anticipating that this previous low is going to be broken and closed below, indicating a new impulsive phase in the market and a new lower low forming. And as we can see, that is ultimately what ends up happening. We form this new lower low, and here's our previous lower high, and this would be the structural range that we are trading within, and thus a new pullback or complex pullback in this case starts to form. We create a high, create a higher low, we create a higher high, we create a lower low that doesn't quite break below the previous low, we create a higher high, we create a low, we create a lower high, we create a lower low, we create a high, we create a higher low, create a higher high, and then ultimately the impulsive phase starts to enter and we come and we break and close below the previous low, creating a new lower low. Now, of course, while this is all happening, this is pretty confusing price action to be taking note of, but the thing that we need to keep in mind is the structural range that we're trading within. This is going to make sure that we're still on track for understanding the bearish price action that is happening. We have our invalidation point high and we have our continuation point low. Our invalidation point high, like I said, is going to be if we break and close above this point, the bearish trend is invalidated and we could potentially be shifting high or bullish. And the previous lower low is our continuation point low, which if we break and close below this, we're expecting some form of lower low to be formed in the markets and for the bearish trend to continue in the market. So it's something that you'll definitely want to take note of in the markets. You know, as I said, we talk a lot about textbook trends where we have those perfect impulsive moves, you know, those singular pullbacks and continuations, but the market isn't so black and white. And this is where the concept of the structural range really comes into play and can save you from being confused when we are in these complex pullback phases within the markets.